Hey there, this is Stephen Wade from Forex Trading Coaches, and wanted to take a minute to show you an incredibly important skill that you can actually implement today and use in your trading to help you avoid false breakouts. Now, let me ask you if this sounds familiar. You've picked out this perfect level in the Forex market, or any other market for that matter, and you've decided that, man, if price breaks through this level, boy, I'm going to make a bunch of pips and it's just going to go to the moon and I'm going to be just a happy camper on this buy trade I have set up. Only to find out that it breaks that level you chose by just a few pips, triggers your entry, and then zips the other way. You lose a ton of pips because you have a deep stop loss because you're breakout trading, and it didn't quite go as planned. Well, this skill you're going to learn today will actually help you avoid that happening to you. Now, Wade and I have been in the Forex market teaching others how to trade, trading, developing systems since 2004. So we've seen a lot of the market, and we're here to tell you folks that for the most part, the market ranges more than it breaks out. So when you are breakout trading, you want to make sure that you've got a pretty significant break of a level before you decide to say, okay, this level's broken, now it's time to keep going in this direction. And again, you're going to learn how to do that today. So let's go over here to the next slide and show you exactly what we do every day in our live trading webinar for our members when we show them how to watch for a break of a level. So the first thing you have to do before being able to avoid the trap of false breakouts is to accurately and consistently identify the support or resistance level that you want to break. It needs to be a significant level. So today we're going to show you how one way that we do that, and you can see that on our charts. So let's jump over to the charts and talk about the support or resistance level that we want to break. So here we are on the daily chart on the pound USD daily chart. And some of the ways that we like to find significant price levels are levels that have been a top and a bottom in the past. So right here you can see that we broke above this level, pulled back, and it kept trading, kept trading, kept trading. So when you come to it in the future, if it breaks below that level, well, history shows the ability to go down another 200 to 300 pips, and maybe even further. So when it comes back to that level, that could be a significant level to break. In addition to that, you'll see future levels as these lows along the way get established. Like right here, you can see in history it was an old top, and then recently a bottom. When that level breaks, that could be good. And then another one could fit into this category, an old daily low, and maybe even sliding it down a little bit to this lower spot. Okay, so these are how we pick these levels that we want to have broken. Even this level initially up here was good. This old high, then it bounced and became a low. Once it eventually broke, then there were some significant moves down there. So these are the ways that we pick levels. So let's, for today's example, let's get rid of these other lines and let's stick with this level that we have showing on the chart right here. Okay? This old top, this old bottom, when we approached this level, back in July of 2014, let's go take a look at how we handle that scenario and show you how to avoid getting stuck into potentially to a false breakout. Okay, so now that we've seen the support resistance part, now let's talk about what to do. What we want to do is wait for the 6 exponential moving average, or EMA, to break that level. So not just price. You're not just looking for price to break that level and then in I go with an entry order and away I go. But rather, what you want to do is look for the exponential moving average, the 6 EMA, to break the level. Now you can choose any moving average you prefer, whatever your favorite is. The one that we use for this, for our system, is the 6 EMA. So let's go show how this looks in the charts. So here we've added the 6 exponential moving average to our chart. And you can see that price broke this level, so we would have this level drawn. We couldn't see the future like this. And you're not quite sure, is it going to be a false breakout or not? You're not quite sure, not quite sure. So you'll notice that, of course, price breaks that level first and kind of rattles around a bit. Then you'll see that the moving average breaks that level. See that? Once the moving average breaks and closes through that level, then we say to ourselves, okay, the odds of this being a false breakout just went down quite a bit. Okay, so you want the moving average, the 6 EMA, to break the level first. Now, a lot of times members will ask us, well, which time frame is the most important? What we do is we wait for the 1 hour chart to break through the level first. But that's not the only time frame. So if we come back to this level and go to the 1 hour chart, you'll see that the 1 hour 6 EMA broke here, right? But then later, if you look at this spot right here, we'll draw a line so we don't lose track of where we are. And you go to the 4 hour chart, later the 4 hour 6 broke through. And then later the daily 6 broke through. So as you break a level and more time frames continue to break the level, that's further confirmation that the break of that level is probably significant enough to get a pretty darn good winning trade entry. Alright, now after the moving average has broken the level, then we wait for a pullback to or close to that 6 EMA. Now, we believe and are here to tell you that this is the correct way to use moving averages, to use them as a floating area of support or resistance. So as you're trading with the trend, you're breaking levels, you pull back to the moving average, that represents an entry area. We're not using the moving average to say, oh, this is going in a downtrend. No, we use other tools for that. But we do use the moving average as a floating area of support or resistance. So as we retrace to it, it becomes a future entry spot. So let's give you some examples on the 1 hour, 4 hour, and daily chart of how we do this. Now we alluded to this earlier, but first you can see that this is our level we've chosen based on the history. First, the 1 hour moving average closed and broke through when this candle closed. When price pulled back to the 1 hour moving average, it wasn't that big of a move. But with our trade management plan, our stops already would have been to break even at that point, and it would have broken even. Not really that great of a trade. But you see what happens is the moving average breaks level, not just price, but the moving average. Then when you pull back to the moving average, in and around it, sometimes slightly through it or a little below it if you can see that there's some other spots to trade in the past, you place your entry. Okay, and then if the 1 hour doesn't take off, which oftentimes it does, it'll take right off there, go 30, 40, 50 pips, 60, 70 pips, you know, and you get a great trade out of that. But if it doesn't take off, then guess what? Well, then the 4 hour can break the level. And when the 4 hour finally closed through and broke the level, it was on this candle. So what do? You wait for a pullback to the moving average or close to it. So let's drop back down to the lower time frame so we can see this closely. This would be the entry over here for when the 4 hour 6 EMA broke the level. Okay, and you can see it on the 4 hour chart as well. It's right here. It's overlapping our line, but you can see when this candle closed through, it broke. When it pulled back up to the 6 near this top again, that was the spot where price took off and ultimately dropped 110 pips. And typically we trade these type of trades with a 30 pip stop loss. Now guess what? The 1 hour does it and the 4 hour does it. Now guess what? The daily will do it. If you've got a good level and it's broken really well and multiple time frames continue to break through it, you get multiple different opportunities for entry. Then it pulls back up right to that same spot again. Now we're over here. So let's slide our line over so we can go down to lower time frame and see how that looks at this peak right here. Okay? And so we can show you in the 4 hour chart what it looks like. Rallies to the daily moving average. Our entry point is up here. And guess what? That's the next spot before price takes a big drop. 130 pips. And then if it really keeps going, then guess what? The weekly will break it. Pulls back up near the weekly 6, and that's been the beginning of a move that's gone 260 pips. So you can see if you're looking for a little bit of a shorter time frame entry that can turn into a higher time frame entry, start with the 1 hour chart. If you want some longer term trades, use the weekly chart. Sometimes even the monthly chart. And you could even take this level over here. See this level? When the weekly moving average finally broke above it, it pulled back, came back to those weekly moving averages or close to them, and shot up for a couple weeks for over 200 pips. And you'll see this over and over. Here's a level on the weekly chart. When the moving average finally closed through it, it was on this candle. When it then subsequently pulled back to that 6 moving average, it produced a base that eventually shot up 300 pips over the next 2 or 3 weeks. So if you want bigger moves, let a higher time frame moving average break that level. But we will begin trading with the way that we do it all the way down to the 1 hour chart and continue to watch and continue to watch, so that as higher time frames moving average breaks that level, we'll get additional opportunities that could represent even more pips. Okay, so to wrap it up, again, we're looking to identify a significant support or resistance area that needs to break. So it's going to be a higher time frame, usually a daily or even a weekly or monthly chart, sometimes even a 4-hour chart, that if you look in history and you say, if this level breaks, man, it can go a bunch of more pips. And I want to make sure that I got a good break before I trade. Then you wait for the 6 EMA to break that level, and then you wait for a pullback to or close to the EMA after the EMA breaks that support resistance level, and you look for your entry. Okay? Now, we have started this series where we're going to have more incredibly valuable training videos coming to you on a weekly basis, like this. Skills that you can actually, the moment you're done watching the video, apply to your trading and improve your trading. So, if you want to see more of these videos, go ahead and subscribe to our Facebook channel, youtube.com/Forex Trading Coaches. In addition to that, you can download our free public charts that look a little bit like what we just showed you. They look a bit different, but you can download those charts, you can get on our mailing list, and then you'll know about our future valuable content and discounts. And you can do that by going to forextradingcoaches.com/free. And I'm going to put these links also just below the video in the description section. So you can just click on the link, it'll take you right there. So go ahead and subscribe to our Facebook channel, go get our free charts, and stay tuned for more valuable information just like this that actually will improve your trading the moment you watch the video. Take care, and we'll see you there in the Facebook channel.